A major update has come out related to Pakistan's economy. The State Bank of Pakistan has decided to keep its policy rate unchanged at 11%. This is the fourth consecutive time that the bank has made no change in the rate. But the question is this a good decision or a risky one? And what effect will it have on ordinary people, businesses, and inflation? Let's understand the details. First, it's important to know what a policy rate actually is. When the state bank lends money to commercial banks, the interest rate it charges them is called the policy rate. If the rate is high, loans become expensive. If the rate is low, people and businesses borrow more, and money circulates faster in the economy. So, the policy rate directly controls how much people spend, how much they invest, and how fast inflation rises or falls. Since July 2024, the state bank has cut the policy rate 11 times, but now it has decided to pause for a while. At the moment, Pakistan's inflation has reached 5.6%, which was just 4.8% a few months ago. Experts say this is a small warning sign. If the rate is reduced further, inflation might rise again. On the other hand, foreign reserves are improving, expected to reach around $15.5 billion by December. This signals that the economy is stabilizing, but it's not yet completely safe. The state bank says that the economy is currently in a recovery phase. Industrial, export, and manufacturing sectors have shown slight improvement. If the rate were lowered right now, people would have more money to spend. But inflation could shoot up again. That's why the bank has chosen a safe route, to keep the rate steady and observe the trend over the next few months. It's just like driving a car at a controlled speed, not too fast, not too slow. Now the question is, what does this mean for ordinary people? Number 1, loans and credit cards. Bank loans, car loans, and business financing will still remain expensive. In simple terms, there's no relief in EMIs yet. Number 2, investments. Fixed deposits and savings accounts will continue giving moderate profits, but stock market activity might stay slow. Number 3, prices. Inflation is somewhat under control, but petrol and imported goods still depend on global market prices. In short, this decision looks like a wait-and-watch strategy. Economists believe that if inflation remains controlled in the next quarter, the bank might lower the rate in the next meeting. However, if floods, import issues, or rising global oil prices occur, the state bank might be forced to raise the rate again. So friends, that was a complete breakdown of Pakistan's current interest rate decision. What do you think? Was this the right step, or should the state bank have lowered the rate further? Share your opinion in the comments below,